Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
G'day and welcome to the COB on this Friday. I'm Andrew Gagan. Thanks for joining us here at AusBiz as we wrap up the day and the week, and what a week it has been. I think I said that last week as well, given what has unfolded obviously in the Middle East and how that is driving market sentiment at the moment, which remains very negative, certainly given what's going on in the oil market. A lot of concerns about how that's likely to flow through to the Australian economy, in particular with potential shortages of fuel, with the government having reacted to that. I'll get to that in just a moment, but look, this is where we are at the moment on the local index. This is just as we're heading towards the close here, slightly in the green on the COB 200 and marginally negative on the ASX 200. So we're finally balanced. It's going to be interesting to see whether we finish in the green or the red when the market settles very shortly. Let's get to what is moving. I mentioned oil as we continue to monitor that fallout from the Middle East. Now, Energy Minister Chris Bowen indicating that Australia will release petrol and diesel from its domestic reserves to help counter disruptions to the fuel supply chain. He says the move will allow the release of up to 20% of the baseline minimum stock holding obligation. That's the equivalent of more than 760 million litres of petrol and diesel. And it's also said that he continues to expect ships to arrive at Australian ports. However, a huge spike in demand has led to local shortages in many parts of regional Australia, and imports will come under further pressure should the conflict in the Middle East continue. Now, 2 weeks ago, the Minister said, well, in fact, 10 days ago, the Minister saying that Australia had 36 days of petrol, 34 days of diesel and 32 days of jet fuel. So that's in fact the highest level in more than a decade, but it is far below the 90-day holding International Energy Agency members are obligated to have. All right, so let's turn to what else is happening. And China, which is Australia's biggest supplier of aviation fuel, has reportedly told refiners to halt exports amid the chaos in global energy markets. Now, the Fin Review reporting the head of oil pricing at data services Argus has seen that directive. China provided about a third of Australia's jet fuel imports last year, so that will remain critical. Let's get to the themes of the day then. How we have played out today. And running dry, well, that obviously refers to fuel, although don't panic. Certainly that's what the government is saying, yet we are still seeing panic, particularly at service stations in remote areas. Safe haven slide, difficult to know where to be at the moment, given the bonds continue to be sold off. Gold also falling as well. Dare I say Bitcoin is holding on to its value at the moment. And rates reckoning. Certainly is going to be a reckoning next week. Tuesday is the day when the Reserve Bank will meet again. Expectations by pretty much all the major banks and economists that it will be hiking rates. Not all of them think that it should, but that appears to be certainly what the market is pricing in at this point. All right, let's get to some further detail just in terms of what we're seeing in energy. Karoon bucking the trend there. Energy gains as Brazil taxes oil exports. That's where Karoon is based, so that shares have come off, whereas the broader energy market has continued to move higher. We did see the Brent crude price jump about 9% overnight. In the financials, that has actually lifted the broader sector, the broader market, I should say. So led by the likes of NAB and Westpac, up close to 2%. Now, I was talking about gold as having fallen further, certainly on a weighed down by a stronger US dollar, and also prospects that central banks are going to have to pivot towards hiking. Now, you'll see the top of that list, Northern Star down 18%. So contributing to that is the falling gold price, but it has also downgraded its production. So that has seen its shares tumble as a result. Excuse me, let's just catch up with those stories then. And just further to Northern Star, they're reaching the lower end of its full-year production guidance, saying will be challenging. Now, Rio partnering with Prysmian in Canada to produce low-carbon aluminium cables for the data centre market. Plus, it has had the death of a contractor in the US. Karoon as I said, bucking the broader energy gains there as Brazil taxes oil exports. Qantas agreeing to pay $105 million to settle a class action regarding flight credits during the COVID pandemic. Shares down marginally, despite obviously airlines been under tremendous pressure at the moment given rising fuel prices. And Immutep hitting a record low on ceasing phase 3 study of its lung cancer treatment trial. Electro-Optic Systems, though, hitting a record high on another defence order out of the Middle East. All right, well, let's get to our stock of the day while we wait for Shane Oliver to join us. And we were on a small cap special today. In fact, we were joined by Luke Winchester from Merrier Capital and Claude Walker from A Rich Life. And stock of the day was Electro-Optic Systems.
They've got another small loss this year before inflecting to profitability in FY27. For me, look, I mean, as I said before, a $2 billion market cap, you're heavily loss-making. I need to look 2 years out to find some profitability. I think there's just too much defence thematic in this stock price today. If I owned it, I'd probably be selling. Maybe not the whole thing, definitely taking profits at least. And as you sort of highlighted before, I think there were some pretty valid questions asked in that short report. I looked through it, and obviously, you know, we know how short sellers work. They're going to throw mud against the wall and see what sticks. But I thought they raised some good enough points where even the ASX had to have a bit of a look and say there are some question marks around that contract.
I think that the share price is going to continue to trade on hype and just expectations. I think there are a lot of traders in the stock. You know, it's obviously doing its best to position itself as a beneficiary of the current conflict and that kind of thing. We saw it hit $10 back in 2020 before it, you know, plunged down all the way to around, you know, well below $2 for years. So I'd avoid it basically, definitely. Look, it could keep going up in the short term if you know, momentum traders are jumping on board, but definitely not even any kind of thesis that I can see would just be gambling to buy shares to me.
You've worked hard for your money all your life. Now your money needs to work hard for you. Whether you're building, transferring or drawing down, the right information makes all the difference. At Ausbiz Retire, you'll find the latest news and insights from trusted experts all in one place. Ausbiz Retire is powered by RAN. Retirement income done differently.
Let's just catch up where we're at on the local market with leaders and laggards, if we can bring that up. Now, among those, NIB Holdings actually up some 6%. Dalrymple also off the back of an update there. Drone Shield, those defence stocks very much remaining in play at the moment, along with energy, and we've seen that with coal stocks in particular, led by Yancol. Also, some of those lithium stocks, Liontown also out with an update as well. Those that have fallen, and let's check in on that list. And Northern Star, as I was mentioning there, with production downgraded, has been hammered today as a result. And Purinix has been under the firing line of late as well. Korean Energy bucking the trend there because of some tax implications for it in Brazil. And those gold miners are under further pressure, including Genesis and Pantoro. All right, well, hopefully we have Shane Oliver with us. He is AMP's Chief Economist. And Shane, welcome. Apologies, we've had some issues technically. We're trying to get hold of you, but great to have you back on the show on this Friday. So much to talk about. So let's get straight to it then. Now, of course, it's all been about oil in the wake of how this war in the Middle East is transpiring at the moment. Interested to know what you're thinking of that market reaction. Particularly, you mentioned the limits of the so-called TARCO trade where Trump always chickens out. Where's his off-ramp at the moment? I mean, can he do that?
Well, that's the big question. I think initially, if you go back 2 weeks ago, just after the war started, there was a fairly mild reaction in investment markets. And that, I think, reflected this assumption that sooner or later Trump would do a TARCO and we'd all be fine. As it's turned out, he did actually try a TARCO on Monday by saying the war would be over very soon, oil prices would plunge. Markets believed it for a little bit, a day or two, and then of course they've gone back to panicking again because it's quite clear that the war is still continuing, has a way to go yet. And of course, I think there's a realisation that TARCO only works if he has full control, and he doesn't have full control. He had full control on the tariffs, what ICE was doing in Minneapolis or what he was doing with the Fed. But in this situation, he doesn't have control, so he can't simply back down and say that it's over. And simply because he's set off a whole bunch of forces that now have a way to play out, including Iran's response. The bottom line is that unless he can get the Strait of Hormuz back under control and ships flowing through there, then the oil disruption continues. And the longer that continues, the more we eat into inventories and the more prices go up and the more we run into, potentially down the track, shortages of oil globally.
Yeah, that's certainly as it's playing out locally too, because of some panic that has emerged in the local market, which the government's trying to head off at the moment. Shane, just in terms of Trump's playbook then, obviously with those fuel prices rising in the States as well, apparently they're up about 20%. Look, clearly his barometers that he's watching at the moment are opinion polls, which are sinking. And obviously the share market, which it's showing cracks, isn't it?
It's certainly showing cracks. I mean, the US share market has been relatively resilient. It's, measured top to bottom, it's down 3 or 4%. Our market's down, depending on when you look at, around 6-7% top to bottom. Europe and Japan, similar fall in Europe and a bit more in Japan. So they're not huge falls. If we bottom out here, you'd say, well, it's a bit of a non-event, just normal volatility. But by the same token, I think it's still early days yet. And I think at the back of many investors' minds is this hope that there will still be some sort of taka or some sort of quick resolution to the war. And that's why oil prices haven't gone up so much. They're down from the highs we saw on Monday of $119 a barrel. But that's the big problem here. It's I think if you go back to the 1970s, you look at those graphs, they're showing the fourfold rise in oil prices in 1973, 74, and the threefold rise in oil prices in 1979. And you think, it just went straight up. Well, it didn't. It unfolded over many months. And maybe you're seeing the same thing this time around. The traders are pricing it in, but they're also pricing in a probability that it might soon end. And that's the problem, that if it doesn't soon end, then there's still a lot more upside in prices. Just to put it in context, if on an optimistic scenario, say 15% of global oil supply has been taken out because of the blockage to the Strait of Hormuz or the effective closure of it, that is 3 times what happened in 1979, which of course was again associated with Iran, the Iranian Revolution at the time. That was 5% of global oil supply. And ultimately that led to a threefold increase in world oil prices. This time around we haven't quite seen that. You might say, well, it's a doubling, or not quite a doubling in terms of $95 for West Texas at present. But obviously, the longer it goes on, you could argue, well, it is actually a bigger shock than we saw back then. And therefore, you could end up with a similar size rise in prices, oil prices at least, maybe even more.
And we look at how that's playing out locally. Obviously, fuel prices are rising here at the same time. Shane, what effect is that going to have, particularly on consumer confidence? It's already taken a hit since the beginning of the war. And also, when you consider the stagflation risk here, we'll get to the RBA in just a moment, but I mean, clearly, and this is a global phenomenon, is it, where you've got rising fuel prices, central banks will be forced to lift rates, but of course, it's also those fuel prices are going to crimp growth.
They will. It's a double-edged sword, and that was the experience in the 1970s. I guess central bankers will think, well, back then on balance, we weren't tough enough. We should have tightened earlier and kept inflation expectations down. And of course they didn't. And then of course by the end of the 70s, inflation was still very much out of control. But and that's, I guess, the problem here. And the flip side, of course, is the hit to consumer confidence. You can see the ANZ Roy Morgan index there is back to the lows we saw in 2023. The Westpac series has held up better, but that's partly helped by consumer surveys in the early part of last week when there wasn't this much fear around the situation in the Middle East. Since then, the survey results at the end of the week actually fell quite sharply. So you've got this sort of double whammy. On the one hand, if petrol prices stay where they are today, at around $2.20 a litre, that compares to about $1.70 a litre back in February. That mathematically adds about 1%, believe it or not, to inflation. It takes us from 3.8% to 5%. So yeah, quite a hefty rise there. That's what the Reserve Bank is most worried about at present. The flip side, though, is that rise in petrol prices will cost the average household about an extra, I think it's about an extra $18 a month where we are at present. And that translates to about an extra, $18 a week or $70 a month. And that, of course, if you add in a rate hike at the same time, it's quite a double whammy for an average household in Australia. So that's all a bit of a problem. I mean, there are some offsets there. You can see in that chart there, I think showing the Aussie dollar, it's looking a little bit stronger, so that's good. But it's not enough of an offset. It hasn't gone up enough to offset the impact of the rise in global oil prices. And so that's the chart with the Aussie dollar. You're still seeing a flow on. I mean, many Australians might look at that and say, oh, it's good. We can go overseas on a holiday, a cheaper holiday now, but depending on where you're going, that's potentially an issue. And I suspect that airlines will be quickly, if they're not doing already, putting up their airfares.
Yeah.
So there's all sorts of issues around this. And the longer term issue for Australia is this, if this goes on for, say, 6 weeks, 2 months, then potentially we start to suffer shortages of oil. And that leads to an output shock as well as an inflation shock.
So, Shane, let's turn to that RBA decision on Tuesday then. Now, I see you think there at AMP that they should leave rates on hold because what you think that trim mean inflation is actually falling a bit faster than they're forecasting, yet you think they will hike.
Yeah, I mean, there's always a difficulty in this role that economists are in. You sort of form your view as to what you think they should do. I mean, this might sound a little bit like having an each-way bet, but you form a view as to what you think they should do. And our view is that, as I mentioned there, we're a little bit more optimistic on underlying inflation. We also think there is an argument to wait until some of the dust settles from this war, just to see how long it goes on for. It could turn out to be brief, it could turn out okay, so to speak, and therefore it be a mistake, hiking rates on Tuesday. But the counter argument, and this is what's reflected in market pricing at present there, and you can see the sharp rise in expectations for the RBA that's occurred in the last 2 weeks. So the counter argument is the Reserve Bank is very worried about inflation expectations. They know they can't do anything about rising global oil prices, but they can do something about a flow-on of that to higher inflation expectations. And that's why I think ultimately they'll probably hike on Tuesday. But it is a close call. I wouldn't be as confident as the money markets are, which are talking about 66% chance of a hike on Tuesday. I think that's probably a little bit too over the top. I'd say it's more like 52% chance, but I think on balance they'll probably hike. And the other thing is, I guess, is that we've seen both the governor and the deputy governor come out with fairly hawkish comments in the last week or so, which would suggest that they're thinking seriously, at least about recommending a rate hike as they go into the meeting on Tuesday.
We shall find out on Tuesday. Shane, meanwhile, probably not a bad time to have a quiet weekend at home. Keep off the roads, unless, of course, you own an EV. Enjoy the weekend.
Unfortunately, I don't have an EV. Hopefully you do.
No. Thanks, Shane.
Cheers.
All the best.
I should get off the fence and buy one.
Shouldn't we all? Probably a bit late now. That's Shane Oliver from AMP. All right, so let's turn to what's ahead. Then overnight, we do have a UK economic growth being revealed, plus goods trade balance. Fourth quarter US GDP growth as well as further job openings there, the JOLTS report to be revealed overnight. Now, ahead next week, of course, the big one that we've been talking about, the RBA rate decision. Markets certainly pricing in a much better than even chance that they will be hiking again. We also get the FOMC rate decision as well, unlikely that it's going to be moving. Unemployment rate is also out on Thursday, and we got rate decisions out of Japan and UK at the same time, followed by the European Central Bank. A lot of central banks primed to make decisions as to whether they need to move. Of course, that has rapidly changed from considerations of cutting to now hiking. Let's return to the market. This is where they're likely to finish up then. Look as though we're finishing in the green. The COB 200 up 0.1%. That is the COB. Thanks for watching and listening.